Okay, can I just turn our attention to the figures for last year, a very difficult period for everyone in the sector. NAV down a third to £10.38. Profit down 3.1% if we strip out the revaluation there, and rental income up 3.7%.
Well, Paul, that's like for like. That's on the same space, and it does demonstrate that we have maintained high levels of occupancy, that we are collecting rents on time, and although there's quite a lot of talk and concern now, and it's very much forward-looking of retailers being under pressure, certainly in 2008 we were collecting rents on time, we were maintaining full occupancy, and indeed we were letting a vacant space. I just point you in terms of new lettings to the success of our new developments. Cabot Circus in Bristol, a 50-50 joint venture with Land Securities, is well over 90% let. We're similar letting levels in Leicester at High Cross. And the benefit of that, I think, the real message I get from that, is that for new lettings in a new centre, retailers have a discrete decision. This is not like a rent review where the rent's going up and they feel that there's no other option for them. When they are signing a lease on a new centre, they are making a discrete decision to grow their business, or that they will see growth in their business by committing to a new lease in a new centre. And I think that the letting figures speak for themselves. Top retailers with strong businesses are seeing that the future growth in their business is dependent upon having the right unit in the right place, and the right place are the large, dominant shopping centres of the type that are in the Hammerson portfolio.
There is talk, though, of landlords having to engage in fairly aggressive rent discounts for a new business. I mean, is Hammerson having to engage in those sort of tactics yet?
I would draw a clear distinction between leasing up a new centre where you've got 100 units to let at once, and working in our existing investment estate where we will only have a couple of vacancies in the whole centre. If I look back on the letting up of Bristol or Leicester, I think it's fair to say that the lettings in 2008 we hit the rental targets that we set, and stretch targets that we set right at the start of the project. And the entire rent roll is virtually spot on our target. The rent-free periods, however, did stretch out a bit. And in our original pro forma, I guess we were working on somewhere around 12 to 15 months. And our early lettings in 2006, we probably achieved that. But by the time we were letting up the final units in 2008, the rent-free period had generally stretched out to 21 to 24 months. If I contrast that with an established centre, if I'd have been sitting here talking to you a year ago, I think I'd have said rent-free periods are 3 to 6 months. They've stretched out a bit. I think now I tell you they're 6 to 9.
I'll just ask you to look back on the past year and a half, and I know it's been a very turbulent time for everyone in the sector. What do you think have been the lessons for Hammerson during that period? Because some property companies are coming out of this, no one's coming out of it unhurt, but some are coming out of it a little stronger than others.
Clearly, with the benefit of 2020 hindsight, we would have sold more. We actually sold over £500 million worth of property in the second half of 2007. And if you add that to the around 245 million we sold in 2008, actually was a significant deleveraging. But looking back with that 2020 hindsight, we could and should have sold more. So my lesson learned, if you like, or if I did it all over again, I would sell more assets while the market was still open in the second half of 2007 or the very early months of 2008.
What do you think prevented you at the time from doing exactly that?
I think quite simply we did not expect the dramatic valuation fall. If I look back on our base case forecasting for 2008, we went into the year with a base case of about a 10% decline in values. And we expected that to be skewed towards the first half of the year. So when we got to the half year and we'd seen a 6% decline in values, wrongly as it turns out, we expected a bit further decline and then a relatively benign, rather boring end to 2008. That, of course, counted without, a tumultuous weekend, the, Fannie Mae and Freddie Mac, AIG, Bank of America buying Merrill Lynch, the demise of Lehman's. I don't think anybody forecast those things, but for a property company where the sale of assets was the obvious solution to a gearing problem, I don't think any of us forecast a market that would be shut for the sale of prime assets.
John Riches, thank you very much.